Hello and welcome to the second part from the ESG reporting series and how to fix ESG reporting. As usual, here the disclaimer that this is my own opinion, and I would like to start with a quick recap of what we did the last time in the previous post. So first, we had a look at the greenhouse gas protocol and how we measure CO2 emissions. And then we had a look at a company that is using basically a business process model, and we said, hey, these concepts, they don't align with each other because some of the scopes, they are not included here, like something like end-of-life treatment of products that we sell. They're just not included in this business process because it's outside of our control and we don't measure it. No? Then we said, okay, there's an e-liability approach, and this approach works as follows. So we have a look at the different participants in our supply chain, starting from here a mining company until the final customer of a product. And then we say, okay, in each sequence or step of the supply chain, we have different emissions. So 5 tons in the first step here for mining iron ore, for example. Then these emissions are passed on to the next supplier, so to say. Then this supplier also adds 2 tons in my example, which is passed on, and so on. And if we just add up all of the different emissions, we can finally calculate how much emissions are included in the final product of our customer. If I'm now this company, I don't know these emissions, but still with this e-liability approach, I can exactly calculate how much emissions are included in the product that I sell to my company that forwards the car or whatever you sell to our customer. Here's the example that we used from accounting perspective. It's an accounting-alike approach. So we say, okay, here we have emissions, here we have incoming emissions, here we sell something, and here we have a closing balance. The closing balance is the beginning of the next period, where we add additional emissions from purchases, and then once we sell something, the emissions are reduced, giving this closing balance. So typical accounting approach that allows us to calculate the CO2 footprint of items that we have on stock, plus the items that we have sold. And for our customer, looks the same, just different numbers. The important thing here is that what is reduced in our area is then the incoming emission for our customer. In the second example, I also said, hey, we need an evaluation system because it makes a difference whether I use a FIFO or LIFO evaluation for the CO2 footprint that we calculate and that we pass on to our customer. So we need a kind of ERP or accounting-like system. And then we said, okay, e-liability concept is an accounting concept. It's simple, accurate, verifiable. There's no double counting of emissions. This is what we currently see when it comes to certain elements of Scope 3 emissions. And it works like a VAT system, but the big advantage is that you have real-time data and insights, and you do not use estimates. Now, I recently found a new study that really implements this concept, this e-liability concept, in a company, Hitachi Energy, and what they did is they wanted to have a comparison of copper. So they said, okay, what difference does it make if we use standard copper, low carbon copper, or if we use recycled copper? I do not want to focus on the product 1, 2, and 3. What I want to focus on is the concept. So here, Boliden is the first supplier in this example. They purchase some emissions in this case, have refining, and these are their emissions per ton of copper. These emissions from this supplier are then passed on to the next one in the chain, ElcoWire. So this one here is this input here. They add something and then they end up with 3,800 tons, which is then the incoming for this company. And also their total emissions is then the incoming purchases or the emissions related to the purchases of Hitachi Energy. So that's a simple concept. If you want to understand more, have a look at this paper and what they did and how they implemented it. Now let's make an additional example. In this example, I assume we are a production company. We purchase raw materials. We incorporate HR and other indirect costs, and then we look only at a single period to keep it simple. Again, we focus only on our company and on our customer. And now let's have a look at the transactions. So first, let me highlight that. We have here, we purchase a fixed asset. For example, a machine, a computer, a building, whatever you have that is needed for producing something. The accounting is highlighted here in white color. So in accounting, in financial accounting, I post fixed asset in debit and accounts payable as a credit. Here I have the different elements of our balance sheet and income statement. So expenses, income, assets, liabilities. And from an accounting perspective, we have an asset 50,000 and a liability of negative 50,000. Typically the IT systems, they put a minus or negative signs for credit transactions. At the same time, we get the information for this fixed asset. We have 20,000 kilos CO2 footprint, and we put this as an e-liability. Next thing, we make a depreciation of this fixed asset. We assume 20 years is the usage or life cycle time of the asset, which gives a depreciation per month of 208 euros. So accountants post depreciation expense versus fixed asset. So we have an expense here and asset value is reduced. From an e-liability perspective, also the e-liability is reduced. Why? Because this is then later incorporated and allocated into our production cost. We will come to that. Therefore, we have here a minus. Next thing, salary and wages. We say, okay, we pay our employees this amount against accounts payable. That's finance and accounting. And then we say, okay, this person is commuting to work, and maybe we don't count anything else. But we say, okay, the CO2 emissions is just 160 kilo of CO2, maybe from his ride with his car to work, which adds up here as an e-liability. Then we purchase electricity, just like in the previous example, in the previous post, electricity expense against accounts payable. And here we purchase 1000 kilowatt hours, which increases our e-liability by 250 kilo. And note what I write here. We say 75% of the electricity is used in production. That's important later on. But we purchase more. So the other 25% is used for our own offices and whatever we have. And then we buy raw materials, raw material A and B. From financial accounting, it's inventory against accounts payable. And from an e-liability accounting, it's a bridging account against this e-liability. So here we have 500 and 150 kilos incoming e-liabilities. Now to the production, I say, okay, I have a BOM, a bill of material, to produce a finished good. I need 100 pieces of raw material A, 50 of raw material B. I need one worker, 160 hours. I have only one worker. So it's very simple, the calculation. I have only a single product. I produce only one item per month. And I use only one machine or fixed asset to keep it as simple as possible. How does it look from financial accounting? And now, if you are familiar with production posting, with production accounting, you might know what's going on here. So you have here a finished product. That's the production cost. And then to produce this item, we take out raw material A and B. These are the costs for raw material A and B. And then we have allocations for electricity, depreciation, and labor cost. That's what we have. So the electricity, we said 75% is going into production. Therefore, we have 750. Then we have the depreciation expense. The full machine is used in production. Therefore, the full depreciation is here. And then the labor cost is also here because we have only one worker and this is a production worker. Just to keep it simple. So these are the expense, income, asset, and liability transactions. And if you calculate that, that's a zero-sum game. So it's basically coming in and out. but not changing our overall profitability. Now from an e-liability perspective is similar. We say, okay, we need raw material A and B, because we increased an e-liability. Here we reduce it, so that's a minus. Why? Because raw material A and B are consumed when we produce the finished good. So this is getting out and this is the finished good getting in. And the same for machine, worker and electricity. So the e-liability is reduced here, but at the same time the e-liability related to the finished good is increasing. So also here this is a zero-sum game. Now if we sell the item, from a financial perspective we say accounts receivable debit, sales revenue credit, and then the cost and stock reduction. And from an e-liability approach, this item that we produced and the CO2 emissions, they are going out. Why? Because our customer gets this. So here are the totals from a financial perspective, and here from an e-liability perspective. Now, if I summarize these numbers in a financial balance sheet and income statement, you see here we have our fixed asset, then we have accounts receivable, and then this profit here comes from the income statement. That's what you know from accounting. And here are our costs. And I can do the same for e-liability, but also calculate ratios. For example, the CO2 emissions that I have per unit of asset, per unit of sales, per item produced. That's all what I can calculate based on this combined approach of accounting and e-liability. Now, the question is, how do you implement this in practice? And I showed you the studies, but I made some additional thoughts. So what we need is an ERP-like system. And the issue is not every accounting software can do this parallel accounting. So the question is, how can even small and medium-sized companies that use a very, very basic accounting system make use of this e-liability approach? So first option would be, hey, get a specialized e-accounting software. This would be the best option. The problem is these tools are not available or very expensive. Second option would be customize or do something yourself. Or this would also be something very nice because it fits your requirements. Disadvantages, you might not have the knowledge. Well, first about how to build such an application and to make the customization, and then also about this e-liability stuff. And then what about cost, budget, and the timeline? And the third option, and that's what I will use, is, hey, use what you have and use the Power Platform to make these additional entries. So it's the easiest one, is possibly the cheapest one, and you use familiar tools. Disadvantage, of course, you need to know the e-liability approach and Power Platform, of course. And your current systems are getting more complex. Why? Because you have additional accounting entries. Okay, so how can it be implemented in practice? So if I assume that this is my accounting system, then I have here the e-liability system. Now the question is, how can I post here and here in parallel? Well, I said, okay, maybe let's use the Power Platform as an interface and then do this parallel accounting. How can it use for different companies? So if I have company A, B, C, I can create additional e-companies A, B, C, or what I can also do is create a single company and then use dimensions, categories, or whatever you have to separate between the emissions for company A, B, and C. Okay, so as a summary. So what I want to focus on and why I like this accounting approach is because CFOs are regularly the ones that deal with sustainability topics. There's a study here from Boston Consulting Group that says, okay, and analyzes, hey, who is actually responsible in companies for this approach? And here is a graphic from the study where accountant and controlling and treasury people are responsible for reporting. They are responsible for helping with the audit. They are doing the carbon pricing, planning, the risk management, and so on. So this concept is nothing new for them. Then what you need is an extension adjustment of the existing tools. you do not necessarily need to buy something new and expensive. Yeah? And in the next post, I want to show you how we can implement this approach, the thing that I just showed you, in our ERP system. And the only ERP system that I have available is a finance operation system. And of course the Power Platform, and I will show you first how we can implement this manually. So I will show you the accounting entries, and then in the next step I will show you how we can automate things with the Power Platform. Okay, that's what I wanted to share with you. As usual, if you have questions, comments, send me an email or put it in the comment section. So thanks a lot, and then till next time.